I'm Nate Lind, and I help people interested in buying or selling online businesses get the transaction done without the deal falling apart. If you're looking to buy or sell online businesses, then be sure to keep tuning in for more videos like this one. Be sure to subscribe and hit the bell for notifications about new videos and interviews. And introduce yourself in the comments. Are you a buyer or a seller? Enjoy the interview.
Hey everybody, Nate Lind here. I've got some kind gentlemen from Bernstein here to talk a little bit about what life looks like after your exit. So for those of you that are looking at a number coming up that's the juicy number, something that has you interested and excited to go through the process of selling your business, but you're wondering what's going to go on afterwards. How is this money going to keep you going? This video is for you. Don, Chris, welcome. Don, can you introduce yourself?
Absolutely, Nate. It's good to see you. Thank you for having us today. I'm a financial advisor at Bernstein, and I work, quite a bit with business owners, often ahead of a transaction, and help them really look at different deals in front of them and figure out what it might look like and what it means, as you said, going forward. And I rely heavily on people from our Wealth Strategies group, Chris Clarkson being one of the leaders, to really help us with that modeling and really to think through those things. So I invited Chris along today just to kind of walk us through an example and talk through some of the subtleties that people should be considering. So Chris, I'll hand it to you.
Well, thank you, Don, and thank you, Nate, for hosting us today. Maybe just a moment to tell you about myself. I have been at Bernstein for 25 years now. I'm a senior vice president and a director, as Don mentioned, in our Wealth Strategies group. That's the research arm for solving the more complex planning problems for our private clients. So sales of a business, stock option planning, charitable planning, retirement planning. I lead our effort up and down the West Coast. We put together the firm's published research on these topics, and I'm a resource to Don and our other financial advisors, really west of the Rocky Mountains. As Don mentioned, one of our primary areas of focus is working with entrepreneurs who are approaching a liquidity event, an offer for their business. And I found that, boy, that can be a time of lots of uncertainty, right? It leads to lots of questions. And if we can help bring some clarity, some peace of mind to what life can look like on the other side of the fence, often that allows the entrepreneur to go to the negotiating table from a much better position, knowing what a particular deal can accomplish. And so I thought that I would bring up an example that might bring it to life for your audience, if that's okay.
Yeah, absolutely. Go ahead and share your screen. For those of you that are watching, that's what you get here at Website Closers. We are a full service brokerage. We want to see the success of the entrepreneur that we're working with from start to finish. And that includes hooking you guys up with some great resources like the guys here from Bernstein that can make sure that we find a great way to achieve your goals after your sale too.
And again, Nate, our goal is to stress test the terms of a specific deal against what it is that the seller would like to accomplish. Whether that's just securing their financial interests, it can be committing time, it can be developing relationships, but we can put numbers to all of these questions. So again, let's look at an example. Now, this happens to be perhaps a more traditional example, a couple that had spent their lives building up their business, had now reached that age, 60, they were approaching retirement, realized they weren't going to be passing the business along to the kids, and wanted to evaluate what life could look like if they were to sell the company. To this point, business had been booming. EBITDA of about $5 million. Now, like a lot of business owners, they had been plowing most of that right back into the company, taken out enough to pay off the mortgage on their home. But other than that, not a big nest egg. They'd saved up about $1 million, not to say that's a small number, but most of that inside of their 401k retirement plan. So if they were going to sell these proceeds, this was going to be it. And they definitely had some goals they wanted to accomplish. It needed to replace the income they'd been drawing from the business and support their spending budget, which was about $25,000 a month, $300,000 per year after taxes. One of the couple had grown up in Colorado and always had a dream of purchasing that ski chalet condo in Vail where the family could come on holidays and through the winter. If there was still enough left over, look, the kids were grown and really had established their own careers, but the sellers were interested in sharing some of that success with family members. And likewise, one of the couple served on the board of a local nonprofit, so they did have some interest in helping out charity. Now, they were looking at a couple of different offers for their business. They had hired a broker who was running a traditional deal process for them and had found two potential suitors. One of them was a competitor interested in making a cash offer for their business, 6 times their EBITDA, $30 million. They were also talking to a private equity firm, a firm that was interested in buying the majority equity interest in the company and then doing a recapitalization, putting some debt on the new entity. So the seller would end up with a $24 million cash payment up front, and they would roll over equity into this new company with the hopes that there would be a second bite at the apple 5 years down the road. Now, this started to lead to some questions. With both of these offers on the table, the sellers were wondering, well, which of these deals is going to be better for me? Are either one of them going to be enough to make sure that we've got enough to secure our spending for the rest of our lives and buy the second home? And then what about some of those other goals? Well, again, this is where a wealth manager like Bernstein can be helpful by addressing and quantifying how the terms of the deal can meet these objectives. Now, the way we do it, we have our own proprietary investment planning model, which bakes in the sum of Bernstein's research on the capital markets and how they behave across a wide variety of economic scenarios, the booms and the busts. And what's so important about this is rather than just building a spreadsheet and saying, well, if you can earn X% return, each and every year, either you're fine or you're not fine. Instead, we want to look again at that range of possibilities, particularly what if the markets end up being especially challenging? What if they're very hostile? Is the seller going to be able to make it no matter what the capital markets can throw their way? And so in this case, we started by answering, well, how much of a spending budget would the proceeds be able to sustainably support even through that very challenging market environment going forward? Now, each of these bars represents the amount that the seller could spend after the transaction. And you notice there's a bunch of bars and they're all different heights, because the answer how much they can spend, it depends. It depends on which transaction structure they go with. And in this case, the darker green bars are the $30 million all cash transaction. And the lighter teal colored bars, well, those are the upfront cash piece of that private equity leveraged recap deal. The answer also depends on how the seller chooses to reinvest those proceeds. And what I've shown here, each of those groups of two represents a different investment strategy, a different asset allocation for the proceeds. And starting on the left, the ultra conservative, I'm not lying with that description. That's actually, what if the seller put half the money into cash money markets and the other half into high quality bonds? Now, not that I necessarily recommend that for the long term, but I will say the seller at the start of our conversations was not particularly comfortable with the stock market. To put it plainly, he said, Chris, I hate stocks. I've never done well in stocks. So I wanted to show him an option without them. Of course, through the course of time, we were able to convince him that a more balanced approach could make some sense. Now, to show you the trade-offs here, I've listed just to the right, the conservative, that's a 20 stock, 80% bond type of mix. The moderately conservative is more of a 40 stock, 60 bond, still a bond-oriented portfolio. And then the moderate on the right is the traditional 60 stock, 40 bond mix. Okay. So let's go back to the left, that ultra conservative portfolio. What if the seller took the private equity transaction, got his cash payment up front, paid his capital gains taxes, bought the ski condo in Vail, reinvested in this ultra conservative portfolio, and then lived off of the money from that point forward? They could spend about $355,000 per year after taxes and grown with inflation for the rest of their lives, and even through the worst of markets that we can envision, not spend through that portfolio. So the good news is, you notice that that bar, in fact, every bar on the screen is above that dotted line, which represents their $300,000 budget. So no matter which deal they took or what they did with the proceeds, they were in great shape. This was going to be more than enough to cover their spending budget. So that definitely brought some peace of mind. But you notice, boy, that ultra conservative allocation, those bars, there isn't a whole lot of cushion over that dotted line hurdle rate. And if, again, they were willing to take that more balanced approach, that would give them a lot more flexibility if they ever wanted or needed to spend more, or maybe give them some room for some of their other objectives. So ultimately, they settled in on that moderately conservative 40-60 type of blend. And if we look, what would that portfolio grow to over time? I've looked here and compared both of the deal structures. So on the left, if they take the $30 million all cash deal, again, pay their taxes, buy the Vail condo, reinvest in that 40-60 moderately conservative asset allocation, and live off of the portfolio, spending $300,000 per year after taxes and grown with inflation, how much will they likely have left 30 years down the road when they hit age 90? Well, the good news is they're still going to have a lot, about $72.6 million. Now, what if they take the leveraged recap deal? Here, what I've done is I've stress tested 3 different outcomes for the equity rollover piece into their new venture. And starting with the stock worthless, what that means is, what if there is no second bite at the apple? What if the upfront cash is the only liquidity event they get, and in fact that equity rollover stub turns out to not have value going forward? Well, the good news is, even in that circumstance, after living off the portfolio for the next 3 decades, they'd still have a $51.5 million legacy to pass along to their kids and grandkids. And if you go all the way to the right, the $12 million sale, that's really what everyone expected, is that if they were able to continue to grow earnings as they had in the past, and they retire some of that debt over the next 5 years, they were expecting that $6 million equity piece to about double in value and be sold for $12 million. And if they did that, gosh, now at 90, they'd have an $83.9 million portfolio to pass along, a very sizable estate. So at some point, they were likely going to need to address the potential estate tax ramifications, but we'll get to that in just a minute. Ultimately, that upside, it did appeal to them enough that they did decide to go with the sale to the private equity firm and do the recapitalization. So at that point, we started to address some of their secondary objectives. And the way that we start that conversation is with this concept. We calculate for the seller what we call their core capital. Well, what is that? That's the size of the nest egg that they would need in order to secure their spending budget for the rest of their lives, even if they live longer than the actuaries say, even if inflation were to come back like it was in the 70s or early 80s, or if the markets turned out to be particularly hostile. We can determine what's the size of the pot of money that would be required to cover those spending needs. Well, when we go through that exercise, in a lot of cases, we find there are assets on the seller's balance sheet that they're never going to need to touch for their spending needs. We call it surplus capital, but that's really the capacity they have for, whether it's a major discretionary purchase, Younger entrepreneurs, we often find they're not done. They're going to roll some of these proceeds into their next venture. Maybe they already have an idea that's outside of a non-compete. Well, we can tell them how much can they afford to invest and seed the new company without threatening their longer-term financial security. Or in this case, it was a seller who was looking to do some planning for his children, grandchildren, and for charity. And often that window in advance of a transaction does offer opportunities for additional planning in that regard. So when we calculated core for the Garcias, here's what the results showed. That basically their number, the number they need to get to from the proceeds to know that they're going to be fine for the rest of their lives, is the one in the bottom teal portion of this bar chart. Basically to cover, buy their ski condo and cover their spending needs, they needed a little shy of $12 million, 11.8. But they were actually going to be getting quite a bit more than that, even just from the upfront cash piece, an additional $8.4 million after tax. And they would also have the equity rollover piece, which ultimately, let's say on the far right, if that were to sell for that $12 million expected price 5 years from now, that would leave them with $16 million of surplus capital to do that additional planning. Again, $16 million above and beyond what they'd need to lock in their own spending budget.
I want to focus on that for a quick second, Chris. This is a common issue that comes up when folks are presented with these type of offers, and it's just a real interesting point for why to take a deal like this and keep 20% in the business. That $16.2 million is pretty darn close to the $24 million cash up front that entrepreneur was going to get. So just leaving 20%, of an equity stake in the business. Oftentimes, folks, that's only if the business doubles, which is pretty modest, view, is nearly as much cash on the second bite of the apple as it was in the first bite of the apple.
Yeah, you're right, Nate. Now we do look at, again, the from that worst case scenario that, gosh, if something were to go horribly wrong with the equity rollover piece, they knew they were going to be okay. But everyone was really quite confident in this case that they'd at least be able to double based on the trajectory of the business as it had been performing in the past. So it left them a whole lot of upside potential that they were not willing to walk away from. When it comes to addressing some of their other needs, we started with their charitable aspirations. Again, he'd been involved on the board of a local charity. And wanted to provide a nice gift. Billy was passionate about the mission there, but at the same time, they didn't necessarily want to overwhelm them with a massive gift all at once. What he really wanted to do was stay involved and continue to support that charity on an ongoing basis. Well, the great news is there are a number of entities that allow you to do just that, to continue to make annual grants to the charity or charities that you care about. But here's the rub. If you're a business owner, that's all fine. But boy, you don't really want a tax deduction each and every year for the gifts you're going to make for the rest of your life. What you'd really like is to accelerate the deduction for all those future gifts to this year when you're selling the company and you have the huge tax spike. But that's what the foundation or a donor advised fund allow you to do. Now, I'll be honest, in this day and age, I find most sellers, entrepreneurs tend to gravitate towards the donor advised fund. That's a much easier vehicle to set up and to administer. It's essentially your own private charitable giving account. You put assets into it, you get the tax deduction when it's funded, and then you get to select gifts out of that donor advised fund to the public nonprofits that you care about in the timing and the amount of your choosing. If you go for a year and you don't want to make a gift, that's fine too. You get full discretion there. You also, it's a little better when it comes to the tax deduction because the contribution that you put in, if it happens to be privately held business shares, you get a deduction based on their fair market value, where if you give them to a private foundation, the deduction isn't as good. It's only based on the cost basis. So for a lot of reasons, the donor advised fund was the right choice here.
And in
Now,
that, the proceeds invested and grow tax-free, so they can, is that donor invested fund, it can still partake in investments and like perhaps investing in real estate or stocks and bonds and other stuff there?
It definitely continues to be a tax-free entity, and the donor will likely get the choice of how to invest it. In most cases, you're going to choose more liquid capital markets investments, a portfolio of stocks and bonds, but it certainly is possible, especially maybe at larger sizes. You could incorporate things like a real estate fund or those kinds of things. It probably isn't the deal to do your own private real estate ventures, but nonetheless, it can definitely incorporate a variety of asset classes in the allocation.
Thanks for watching. If you liked this video, be sure to subscribe and tell me what you thought about it in the comments. Your comments encourage me to continue posting videos, and they give me ideas about what to post next. I read and reply to every single one. Also, if you own an online business and you're curious of how much it's worth, click the link below to get a free business valuation with a member of our team. Who knows? It may even be me you're talking to.